Now let's talk about one of our favorite strategies, the short option, where we would sell an option as an opening trade with the hopes that the price of the option will go lower. A put option gives the option holder the right, but not the obligation, to sell shares of stock at an agreed upon price, the strike price, on or before a particular date, the expiration date. So if you buy a put option, then you'd be buying this right to sell stock. But there are two sides to every trade, and you can take either side. So we could also sell an option as an opening trade. This is called being short the option, which is a bet that the option is overpriced and the price of the option will go lower. Rather than profiting from the option's price rising, like you would if you were buying an option, you'd simply profit from the option's price going lower. So you would want to sell it as an opening trade at a higher price and buy it back as a closing trade at a lower price. So with selling an option, you are selling this right to someone. You're selling the right for them to sell stock. So you're taking on their risk and you're getting paid to do so. And if you think about it, selling a put option is just like providing insurance. So let's say you sell a put option and then the stock crashes, and the option holder decides to exercise his right to sell stock at the strike price. Well, remember, you sold him this right, so you are now obligated to buy his shares from him at the strike price. So just like a car insurance provider would prefer for you to not crash your car, someone who sells a put option as an opening trade is hoping that the stock will not crash. Specifically, if you sell a put option, you are hoping that the stock will stay above the strike price. Now, we can also sell a call option as an opening trade. It's the exact same concept, except we would do this in hopes that the stock would stay below the strike price. So selling a put option is a bullish to neutral bet. You want the stock to go up, but if it doesn't go up, that's fine too, as long as the stock stays above your strike price. That's why we say it's bullish to neutral. And selling a call is bearish to neutral. Check out this chart of Facebook. Facebook stock is trading at just above $117 per share. Now, we don't know where the stock will go, but let's say we'd like to bet that the stock won't go above 125 during the next month or so. Knowing that all out-of-the-money options expire worthless, we could sell the 125 strike call option. And the idea is we are hoping that this option that we sold will remain out of the money and the option's price will gradually decay to zero. So that's the cool thing about selling options. Rather than betting where the stock will go, we are betting where the stock won't go, which is extremely powerful. So in this case, we're betting that the stock won't go above $125 per share. Let's just check to see what the 125 strike call is trading for. Looking at the option chain, you can see the price of the 125 strike call is around 102, and this option has 46 days to expiration. So we'll just say that we sold one contract of this call option at 102. And knowing that option prices have a multiplier of 100, this means we collected $102 to sell this option. Now let's look at a few different scenarios and talk about how this trade will make us money and also how we can lose money on this trade. First, let's say the stock doesn't do much and just kind of trades sideways. Maybe it goes up a little bit and ends up at, let's just say, $122 per share. If the stock is at $122 per share, this call option will be considered out of the money and will be worthless. So in this scenario, we simply get to keep the $102 we collected to enter this trade. It doesn't matter if the stock goes down, stays sideways, or even goes up a little bit. As long as it stays below our short call strike, then we will make the max profit of $102. Or in other words, our max profit is simply the amount we sold the option for. Now, scenario 2. Let's say the stock doesn't cooperate and it ends up going to, let's just say $128 per share. If the stock is at 128 at the expiration date, then the 125 strike call option will be worth its intrinsic value of 3. So if we sold this option at 102 and it's now trading at 3, then we have a loss of 198 on the trade. Now here's the thing about selling options. If there is no limit to how high the stock can go, then theoretically selling an option like this is said to have unlimited risk, right? As the stock goes higher and higher, this option will get more and more valuable. And since we are short the option, that means we'd be losing more and more money. And this is exactly why the short option strategy gets such a bad reputation. You're taking tons of risk and have limited profit potential. It doesn't seem to make sense. Or does it? We say it does. It absolutely makes sense because in exchange for taking risk and capping your potential profits, you're being rewarded with a very high probability of profit. Buying an option like we showed you in the last section is said to have very little risk and unlimited profit potential. And selling an option is said to have unlimited risk and limited profit potential. Which one sounds better? Of course, buying options looks very attractive at first glance. Unlimited profits, very little risk? Sure, sign me up. But in life, does anything really ever pay without taking risk? Now, the reason I point this out to you is because you'll likely hear over and over again that selling options is extremely risky. We don't believe this to be true. We believe that the theoretical risk is much higher than the actual risk. Now, let's actually make a live trade so you can follow along and learn. And actually, let's make two trades. We're going to trade a short call and a short put. But for the first trade, let's trade a short call in Caterpillar, ticker symbol CAT. Now, if we look at a chart of the stock, you can see that it's trading at just above $95 per share. So if we sell a call option in Caterpillar, then that would be a bet that the stock will stay below some level, and that level would be determined by whatever strike price we choose. So let's just look at the option chain. Let's just choose the December expiration with 11 days left. Now we just have to choose which strike price we want to trade. Remember in the Option Greeks chapter when we said delta can help us choose which strike to trade? Well, you can see that we have delta and probability in the money displayed on the option chain. And you can see that for each strike, the delta and probability in the money number are very similar. So delta can actually tell us the probability of our option being in the money at the expiration date. For example, you can see the delta on the 100 strike call option is 12. What this is suggesting is that there is a 12% chance that Caterpillar stock will be above 100 11 days from now. Now the cool thing is this also tells us the probability of Caterpillar being below 100 in 11 days. If there is a 12% chance of the stock being above 100, then there is an 88% chance of the stock being below 100. And remember, selling a call option is simply just a bet that the stock will be below some level. Now, you're looking at the Thinkorswim platform, but if you are using another platform that doesn't have the probability in the money feature, you can simply use delta because every option trading platform should have delta. And you can see that the numbers are very similar. But for now, we're going to remove delta and just look at probability in the money. Remember with buying options, we talked about how choosing a further out of the money strike would result in a lower probability of success? Well, the opposite is true for selling options. If we choose a further out of the money strike price, you can see that it has a lower probability in the money. So therefore, if it has a lower probability in the money, then it would have a higher probability of being out of the money. And when selling an option, we want it to remain out of the money. And actually, we can just go ahead and change the way this is displayed on the option chain. We can change this probability in the money column to probability out of the money. Now, you can see that the further out of the money strikes have a higher chance of remaining out of the money and therefore expiring worthless. So choosing a further out of the money strike would give us a higher chance of the trade being profitable. But there's a trade-off. Remember, when selling an option, our maximum potential profit is simply whatever we sell the option for. And you can see that the further out of the money an option is, the cheaper it is. So to sum it up, going further out of the money when selling an option will result in a higher probability of profit, but at the same time you'll have a smaller profit potential. If we sold this 101 strike call right now, sure, we'll have a very high probability of making money, but the profit potential is only 15 cents per contract. So if we sold one contract, we can only make $15. Now, on the other hand, if we choose a strike price that is much closer to the stock price, then we will have a much higher profit potential, but a lower probability of profit. And there really is no magic number when it comes to strike selection. It's more about just finding a good balance. For this example, let's just meet somewhere in the middle and trade the 99 strike call that has an 84% chance of remaining out of the money. And then let's go ahead and make this trade. All we have to do is right-click on the bid or the ask of the option and click Sell Single. Here we can adjust our price we want to enter the trade at and a few other things like position sizing, type of order, etc. For this trade, we're going to stick to one contract. Now keep in mind, we are selling an option, so we want this order to get filled at the highest price possible. Just remember, buy low, sell high. So let's go ahead and put in this order at 35 cents. Now, when we click Confirm and Send, you can see the details of the trade. You can see the break-even stock price is $99.35, which is simply just the strike price plus the entry price, and we want the stock to stay below that level. Now, the max profit is whatever we sell the option for. In this case, it's $35. Max loss says infinite, because in theory, the stock can go to infinity, right? But again, we like to rephrase this and say that our max loss is undefined. Now, let's skip down to the buying power effect, or in other words, our capital requirement for the trade. When we bought an option, our capital requirement was obvious. Since our max loss was limited and we could only lose whatever we paid for the option, our capital requirement was simply just the price we paid for the option. But in this case, we aren't buying the option, we are selling it. And theoretically, our max loss is infinite. So how is the capital requirement determined? Well, it's simply determined by our brokerage firm. Our theoretical risk is infinite. So the brokerage firm really just has to make their best guess at what our real risk is. And in this case, you can see that the capital required for the trade is just over $1,500. Always check this number before selling an option, as it's important to know how much of your capital the trade will tie up. And actually, we would consider this number to be pretty high, and that's mostly due to the fact that we chose an expiration date with so few days to expiration, which is one of the reasons we usually choose to place our trades with somewhere between 30 and 60 days. But either way, let's go ahead and send this order to hopefully get in the trade. Okay, so we just got filled and we are in the trade at 35 cents. Now, the stock is currently at around 95 per share. The best case scenario for this trade is that the stock stays below our short call strike of 99. If that happens, then we will get to keep the max potential profit of $35. And we're going to see what happens. But now let's quickly place another short option trade, but this time let's sell a put option. Let's make a trade in ticker symbol GDX. Selling a put option is a bet that the stock will stay above some level until the expiration date. And that level is, again, determined by the strike price we choose. So let's check out the option chain and make a trade. Now, all the same rules apply for the short put option as they did with the call. Choosing a further out of the money strike will result in a higher probability of profit. But at the same time, it will have a smaller profit potential. So let's just find a happy medium, and we're going to choose the 20 strike put. You can see that this put option has around a 67% chance of being out of the money at the expiration date in 11 days. So in other words, if we sell this put option, then we will have a 67% chance of keeping the maximum potential profit of whatever we sell the option for. So let's go ahead and make this trade. We're just going to right click, click sell, single. And again, we're just going to trade one contract and we're going to put in the order at 37 cents. Now you can see this trade has a much smaller buying power effect, or in other words, it has a much smaller capital requirement of just $329. Some underlying stocks have a more favorable capital requirement for selling options, and others are just outrageous. And it really all comes down to the price of the underlying stock, the implied volatility, etc. Just make sure you check what it is before making the trade. So let's go ahead and send this order and get in the trade. Okay, so there, we got filled on the trade. Now that we're in both of these trades, let's see how they do as time passes and we near expiration. You can see the GDX position at the top of your screen and also the Caterpillar position just under that. And you can see the profit or loss for each position here. You can also see the profit or loss for each day, and you'll notice that we have a chart of each stock price at the bottom of your screen with GDX on the left and Caterpillar on the right. For GDX, we are simply hoping that the stock will stay above 20, which is the strike price of the put option we sold for 37 cents. And for Caterpillar, it's the exact opposite. We are short the 99 strike call, so we are hoping that the stock price will stay below 99 over the next 11 days. Now, as each day passes, we'll show you how each position is doing, and we're not going to take profits, cut losses, or anything like that. We are simply going to hold each trade to expiration so you can see how they perform. And actually, we're hoping that at least one of these trades will be a losing trade, as you aren't going to learn from only seeing profitable trades. We have 11 days to expiration. Now, fast forward one day, and you can see that both stock prices have risen. For GDX, that's a good thing because you can see our delta on the position is a positive 26.61. So since this number is positive, that means we are benefiting from the price of GDX going higher. But for Caterpillar, you can see that we have a delta of negative 21.42. So that means we will lose money if the price of Caterpillar stock goes higher. So you can see the stock went higher today and we are down $10.50 on the trade. Okay, fast forward one more day. We now have 9 days left to expiration. The price of GDX has fallen quite a bit and is approaching our short strike that we want the stock to stay above. So you can see we are down around $15 on the day, and our total P&L open is negative $9. And for Caterpillar, you can see the stock has went in our favor quite a bit today, and we are up $26.50 on the day, for a total P&L open of $14. If we fast forward just one more day, you can see that our Caterpillar trade is fine still. But the price of GDX has fallen quite a bit and has pierced through our strike price of 20 that we wanted the stock to stay above. Because of this, you can see that the option we sold as an opening trade at 37 cents is now at 123. Because remember, put options rise in value when the stock falls. So we are down around 86 cents on the trade. Or since we are short one contract, that means we are down $86 on the position. But I also want to point out something else real quick. You can see our delta is now plus 70. But a few days ago, it was much smaller than that at around plus 26. And that's just the nature of short options. As the position goes against us, our deltas will grow. This is often talked about in the trading community as gamma risk, because if we are short an option, we are exposed to a lot of gamma, which again is the rate of change of delta. And this is the trade-off for the fact that we have time decay in our favor, which is measured by theta. Any strategy where time decay is in your favor, you will have gamma against you. I just want to point this out as this is why it's so important to keep your position sizing in check and also choose an appropriate time frame for your trades by choosing an expiration that has less gamma exposure. Remember, we tend to place our trades in an expiration cycle with around 30 to 60 days to expiration. But for these two trades, we broke that rule and decided to place a trade with 11 days to expiration, and that's why our deltas have grown so fast. Now, this delta of plus 70 will actually never increase to higher than 100, right? Because we are only short one contract, and one contract equals 100 shares of stock. So this delta can never increase to higher than 100. Now, we actually think of this as a great thing, as we tend to be, not always, but we tend to be more bullish on stocks that have recently sold off and bearish on stocks that have been making new highs. So you can think of this as, as GDX goes lower, we are getting more long the stock, right? Which is nice because if we were bullish when the stock was around 21 per share, then we're going to be even more bullish when the stock is around 19. So, alright, I just wanted to point that out. Now I'm going to show you the rest of the trade cycle, and you can see Caterpillar is doing just fine right now, and GDX is struggling a bit. Best case scenario is that Caterpillar stays right where it's at, and the call option that we are short will gradually decay to zero. And for GDX, we'd really like the stock to bounce at this point and rise back above $20 per share. So let's fast forward and see what happens. And we now have 0 days left to expiration. These options literally expire this evening after the market closes. So for Caterpillar, the option is pretty far out of the money, and it's highly unlikely that the stock will get to 99 before the day is over. So for this one, we can simply leave the position and let it expire out of the money. If we do this, we will simply keep the $35 that we sold the option for, and over the weekend, the position will be removed from our account. And come Monday morning, we will no longer have the position, but we will have made $35 on the trade. It's like we are out of the position at zero, and we didn't have to pay any trade fees to close the position. Now for GDX, it's a slightly different story. This option is in the money, and if we were to hold this short option through expiration, it would then turn into long stock. Come Monday morning, we'd no longer be short the 20 strike put, but we'd be long the stock at $20 per share. Now, this is fine if you want to own the stock, but let's assume we don't want to own the stock for whatever reason. We definitely want to close the position today before expiration. You can see we are down $47.50 on the trade. Let's go ahead and close the position now and get rid of it so it doesn't turn into stock. Now, you can see the order to close the put option, and this is a buy order. Remember, we sold the option as an opening trade, and we are now buying back the option as a closing trade. This terminology may confuse you at first if you are used to referring to positions as buying them to open and selling them to close, but scratch all of that because now you know that we can sell something as an opening trade and we can buy it as a closing trade. So you can see the order to close a position, and you can adjust the price or type of order or whatever, but for this trade, we're just going to enter it like this and close the option at the current price of 76 cents. So we'll click confirm and send, and you can of course see the details of the trade, but for closing trades, all of this information doesn't really matter or make any sense anyways. So we're just going to go ahead and click the send button to send the order. You can see we still haven't filled on the trade. Our order is in to buy this option at 76 cents, but you can see the bid price is 76 cents and the ask price is 79. So for us to get filled immediately, we may need to cancel and replace this order and change the price a little bit. So we're going to go ahead and do that. We'll just click cancel replace, and we're going to change the price from 76 to 78 and see if we can get filled at that price. Okay, so there, you can see we got filled on the trade. Now let's recap and see how much money we lost on the position. So you can see we sold this option at 37 cents, and we bought it back to close it at 78 cents. So the amount we lost on the trade is simply the difference between these two numbers, right? So if we take the difference, that means we simply lost $41 on this trade. And on the Caterpillar trade, we opened that one at 35 cents, and it will expire worthless and be removed from our account over the weekend. So we are essentially out of this position at zero. So on that position, we made $35. So not bad. Between both of these trade examples, we lost a few bucks overall. But I actually want to mention that we did a few takes on these trades in hopes that at least one of them would be a losing trade. Besides these two, we actually made 3 other trades in Apple, QQQ, and DIA. The reason we did this is because we were hoping at least one of these trades would be a losing trade, because we wanted to show you what to do in that scenario as well, as you're not really going to learn by simply looking at a bunch of profitable trades that all expired worthless. But you can see that these other 3 trades were also profitable, just like the Caterpillar trade. The reason I wanted to show you this is to show you how powerful it is to trade a high probability trading strategy. Since these strategies had a very high probability of profit, we were able to make a profit on 4 of them and only lose money on 1 of them. That's a pretty high percentage of winning trades versus losing trades. Let's quickly recap. A short call is a bearish to neutral strategy, where we want the underlying stock price to go down or at least stay below the strike price of the option. Time decay is in our favor, which is why this strategy provides so much consistency, and we'd also benefit from a decrease in implied volatility. Because remember, selling options is like selling insurance, and implied volatility is a good measure of fear. When fear, or implied volatility, is high, then insurance, or option prices, will be more expensive. Now, our max profit is simply the price we sold the option for, and the max loss is undefined because there's no limit to how high the stock can go. As the stock goes higher and higher, we will lose more and more money. Our break-even is the strike price plus the entry price. If the stock is below our break-even, we would have a profit, and if it's above this point at the expiration date, then we will have a loss. Alright guys, that's it for the short call strategy. Now let's quickly go over the short put strategy. A short put is the exact same concept as the short call, except it's a bullish to neutral strategy, where we want the underlying stock price to go up or at least stay above the strike price of the option. Time decay will still be in our favor, and we'd still benefit from a decrease in implied volatility. Now, the break-even on a short put is the strike price minus the entry price. If the stock is above our break-even, we would have a profit, and if it's below this point, then we will have a loss. Now, your max profit is still just the price we sold the option for, but the max loss on a short put is technically not undefined. Remember, we would lose money on a short put if the stock pierces through the strike price and keeps going lower and lower. But the stock can only go so low, it can't go below 0. So technically the max loss on a short put trade is equal to our break-even stock price. For example, on the trade we just showed you in GDX where we were short the 20 strike put at 35 cents, our break-even stock price was $19.65, right? Well, in this example, our max loss would also be $19.65. And if we were short 1 put option, then that would be equal to $1,965. So technically the max loss on a short put is simply the strike price minus the entry price. So alright guys, hope you enjoyed the video. If you did, make sure to click the like and subscribe button below. And also be sure to check out our 3 free video series by clicking the link in the video description below. These videos will help your trading tremendously, and they are completely free. All you have to do is click the link, input your email, and we will send you the 3 videos. So I will see you there.